In this podcast, we're going to be looking at what happens when an account goes up or down. A recap from last podcast, we actually looked at the nature of accounts. So in other words, whether an account has a debit or a credit nature. From the last podcast, we know that assets have a debit nature along with expenses and drawings, with revenues having a credit nature along with liabilities and also capital contributions. So what actually happens when an account goes up or down? So you can see on this table here, we have summarized the nature of all of the different types of accounts in accounting, that being assets, liabilities, owner's equity, revenue, and expenses, and the nature of those, with assets, as previously stated, having a debit nature, liabilities having a credit nature, capital contributions having a credit nature, and drawings having a debit, and revenue having a credit nature and expenses having debit. So when an asset goes up, for example, or any account for that matter, it actually keeps the nature of that account. So for example, if we actually bought a motor vehicle, the motor vehicle account being an asset has a debit nature, and since we have bought a motor vehicle, we have more motor vehicles than previously, so therefore this has a debit nature. However, if we actually sell that motor vehicle in the future, so for intensive purposes, we sell a motor vehicle in 3 years' time, that asset is going down, so therefore it has a credit nature. So when an account goes down, it swaps its nature to the opposite, that being from a debit to a credit, or for liabilities, for example, if we pay an account going from a credit to a debit. So you need to know these rules for your IA1 exam. In future vodcasts, we're going to be looking at transaction analysis, but in order to understand that, here are some hints and tips in order to decipher what is actually going on in any of these transactions which we'll be looking at in the future. So for example, when you see the word paid in any transaction, we either are paying for an expense, an asset, or paying off accounts payable. And with accounts payable, you'll see a name of an organization there. If you actually see names of organizations and credit, those one type of account will either be an account receivable or accounts payable. So if you actually see the word received or undertook services revenue on credit, that will determine that there is an accounts receivable because someone actually owes us money. If, for example, we actually buy supplies on credit and there is a name of an organization, that will actually depict an accounts payable because we are actually buying. Now, when you see the word cash, two types of accounts can actually occur, that being services revenue if we perform services for cash, or the other account is obviously cash at bank. Now the cash at bank will either be going up or down depending on what we are actually doing. So for example, if you see the word pay wages for cash, you know that we've actually incurred an expense being wages, and also a decrease in cash at bank because we're paying wages out of our cash at bank account. When you see the word receive in any transaction, two accounts will actually be affected, that being accounts receivable because more than likely we're receiving a debt that is owed to us, and also services revenue because we will be performing a service as well if we receive money or perform services. Now when you see the owner's name, it can only mean two things, that being drawings or a capital contribution. So a drawing is when the owner takes assets or money out of the business, and a capital contribution is when the owner actually puts assets or liabilities into the business, and this usually happens at the commencement of the actual business itself, or if they actually need more money into the actual business itself. So you need to look for these keywords when you are looking at the transactions analysis. Paid, any organizations and the word credit, where you see the word cash, where you see the word receive, or where you actually see the owner's name, those various accounts will be affected when you see those types of words in transactions. Now here's a worked example that we're actually going to be going through. So a transaction that you might see in future questions and transactions may be buying an asset for cash. And in this case, we're buying a motor vehicle for $50,000. Now, using that table that we had from the previous slides, tip number one, the transaction has the word cash in the transaction. So cash at bank will be one account that is affected. Now in any transaction analysis, there's usually a minimum of 2 accounts that have been affected in a transaction. Sometimes they may be more if the owner is contributing a number of accounts to start the business. Tip number 2, after the word bought or paid, it discloses the other account. In this case, it is a motor vehicle. Now you need to decide whether that account is an expense or an asset. Now remembering you will have a chart of accounts in the exam, and the tips are as follows. If you number 1 represents revenues on the chart of accounts, number 2 represents expenses, number 3 represents assets, number 4 liabilities, 5 capital contributions and drawings. So if you don't know what the type of account it actually is, look for the word motor vehicle and you will find that it is actually in the asset column, which is depicted by number 3. So therefore it is an asset. Tip number 3, you need to determine whether cash at bank has increased or decreased and whether there is more motor vehicle as a result of this transaction.
Okay, let's go.
Let's go. Let's have a look at this transaction and see how the cash at bank and the motor vehicle accounts are actually affected. Transaction analysis, I have put the 2 accounts here that are in question, one being the motor vehicle and the other one being cash at bank. Now, both are assets, so therefore they have a debit nature. Now, with the motor vehicle is increasing, it therefore has a debit nature and therefore an amount here of $50,000. Cash at bank, having a debit nature, it is decreasing and therefore has a credit of $50,000. Now you need to make sure that the debits and the credits add up and are equal. So we have a debit of 50 and a credit of $50,000. So one of my tips that I actually have for you to decide whether an account is going up or down is to answer these 3 questions in any transaction analysis. How many motor vehicles did the organization have before the transaction? And the answer to that is none. How many motor vehicles did the organization have after transaction? We have one motor vehicle now. So therefore, as a result of this transaction, the motor vehicle account is increasing, and therefore, according to the accounting rules, we actually keep the nature of the account. So we do not change the nature from a debit to a credit. It keeps the same as a debit because it is actually increasing. Now, if you don't understand those, go back 3 or 4 slides to that table and use that as a structure in order to work through any of these transactions. If you look at the cash at bank account, how much cash did the organization have before the transaction? And I'm assuming that we started the business, so therefore they had 0 money in their bank account. How much cash does the organization have now after the transaction? Because we actually paid for a motor vehicle out of this account, we have now negative $50,000 in this in the cash at bank account. Okay, so therefore, because it is decreasing, the nature changes from a debit to a credit. Worked example number 2. We actually paid wages for cash for $1,000. Now using these tips again, the transaction has the word cash in it, so therefore one of the accounts that is affected in this transaction is cash at bank. Tip number 2, it actually tells you what we're actually paying, so that will be one account. So we are actually paying wages. Now wages is an expense, so it will actually have an account number 2 in the chart of accounts. Again, if you don't know what wages actually is, look for the word in your chart of accounts in the exam, and you'll actually determine using the account number starting with 2 that it is an actual expense. And the next tip, you need to determine whether cash at bank is going up or down, and whether the wages account is going up or down as a result of this transaction. Now, using this little table again in transaction analysis, I've put in the 2 accounts that are affected, wages expense and also cash at bank. Now, wages expense being an expense has a debit nature, and cash at bank being an asset has a debit nature. Now, if you look at this actual transaction here, we need to determine whether we have more wages in the account or whether there are less wages in the account as a result of paying wages. Again, using these 3 simple questions. How much wages does the organization pay now after the transaction? And the answer to that is we have paid $1,000 worth of wages. So the account has actually gone up, because before this transaction there was nil wages being paid as before this transaction actually took place. So therefore we keep the nature because it is increasing, and wages has a debit of $1,000. With the cash at bank account, same example, same analysis as the previous one where we actually paid for a motor vehicle. The cash at bank is going down because we have paid an expense out of this bank account. So you think of it this way: how much cash did the organization have before the transaction? And the answer is nil. How much cash did the organization have now after the transaction? And because we're paying out $1,000, they have a negative amount in the cash at bank balance. So think of it, generally speaking, as if you actually bought a BLT from the Great Lutheran Tuck Shop, you would have less money in your account as a result of paying for the actual burger, but you have one more burger as a result, and that burger will obviously be an asset, depending on how you actually look at it.
Can somebody give me a higher?
Hopefully you are getting what is actually going on in any transaction. Again, if you don't understand it, go back to the accounting rules and that table and look at what happens with the nature of accounts when they go up or down. Worked example number 3, B blogs paid $500. Now, tip number 1, even though the transaction has not got the word cash in the transaction, cash at bank is actually implied because there is an amount here of $500. So with any transaction, regardless of whether it's for our organization or someone else's, usually when there is a sum of money involved, there is some money being exchanged through the cash at bank. Tip number 2, after the word paid, it discloses the other account. And in this case, it is accounts receivable. Now, another tip here, there is an actual name. So in this case, B blogs is an accounts receivable because they are paying us an amount which therefore reduces their debt. The only time it would actually be an accounts payable if we were actually paying B blogs. So it might say something like, we paid B blogs $500. So tip number 3, you need to determine whether the cash at bank has gone up or down, and whether accounts receivable has gone up or down as a result of this transaction. Looking at this transaction analysis, the 2 accounts in question is accounts receivable and also cash at bank. Now, accounts receivable is an asset, so therefore it has a debit nature. Cash at bank, as we know, is an asset, therefore has a debit nature. Now, when you look at this transaction, we are actually receiving money here, so therefore our cash at bank account is going up by $500. So therefore, as an asset is increasing, it keeps its nature, and therefore we debit the cash at bank account for $500. Okay, now looking at accounts receivable, ask yourself this question: how much does a person owe the organization before this transaction? And the answer is $500. Now, since he's actually paying us the debt, he or she actually owes us $0 now as a result of this transaction. So therefore, the account receivable is going down, essentially from $500 to 0. So an account receivable decreasing, being an asset, you need to change the account nature from a debit to a credit, making sure that both the debit and the credit side equal. In this case, it does, equaling $500. Now it's your turn to work out the accounts in the following examples. The answer will appear after 30 seconds. Let's go. Paid stationery for $150. Example number 1. Remember to set out your answer in a transactional analysis table if you do not understand how to do it from the beginning. Now, the transaction analysis table is having a stationery expense being a debit, as it is an expense, and it's increasing, therefore have $150 on the debit side. Now, a stationery expense, because it is an expense because the asset, usually a pen or a pencil or a highlighter, usually doesn't last more than 12 months, and it is not an item of considerable value for the organization, so therefore it is an expense. Cash at bank, being an asset, has a debit nature, and because it is going down, because we're paying for something, has a credit nature of $150. Example number 2, perform services revenue for $1,000. Services revenue, being a revenue account, has a credit nature, and because we're performing a service, it is increasing and therefore keeps its nature for $1,000. Cash at bank is an asset which has a debit nature, and it is increasing as well, and therefore keeps its nature of $1,000. Now, because it is cash at bank and not an account receivable, is because there is no name here of any organization that we perform the service for, nor is the word credit there as well. So you can safely assume that if it's just something like this for $1,000, that there is cash at bank and money is going into our account for performing that service. Example number 3, owner withdrew cash for $1,000. Now, because we have the word owner here and withdrawing some money, the account for the owner's equity is drawings. And drawings has a debit nature, and because he or she is withdrawing more money out of the business, it keeps its nature for $1,000. Now, cash at bank is implicated here because of the word cash, and being an asset has a debit nature, and because more money is coming out of the account, it has a credit nature for $1,000, therefore making the debits and the credits equal. Okay, that is all for this vodcast. What we're going to be doing next vodcast is looking at the 6 general journals that you'll need to know for the IA1 exam.